Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Sherman.
Welcome everyone to another episode of Sparta Market Outlook. Currently here in Singapore, together with my colleagues Hua and Jun. So we're actually doing a live podcast here, all the three of us. We also have on the line Neil, who is joining from Vienna. How are you, Neil?
I'm good, thanks.
Excellent, good to have you. And Hua, it's the first time you're on the pod or not?
Second time, actually. So really good to be here. Thank you for having me.
So Hua, we're now live on fuel oil. So that's the first thing. That's the exciting part of Sparta. And obviously, since we're all here in Singapore, we're going to have an episode that is very East of Suez oriented, talking about crude, but obviously about fuel oil. So you can tell us all about what you've discovered from the tool. But let's start with the main agenda, if you want. What are the headline points right now? I understand there was JODI releasing some data yesterday. Maybe, Neil, you want to talk about that first?
Yeah, I'll go for it. So a quick one on JODI. That's December data, and a couple of points that stuck with me, I suppose. First thing is that crude stocks in sort of combined OECD, Europe and Asia drew quite a lot, and they're fairly down year on year. So that's a decent bullish report from the crude perspective. And second thing is it's the same thing for kind of gas oil. So gas oil in Europe, for example, stocks didn't really build as they should do in December. And there's a couple of things to note on that one. Runs in Europe were actually quite disappointing, I thought, from a kind of seasonal perspective. And imports into Europe, gas oil imports into Europe, were also very low. And that kind of overwhelmed the picture of very poor demand. So the demand numbers in Europe for December were extremely poor, I thought. But we still managed to kind of keep the stock picture in check because imports were quite low, partly that. So overall, it was kind of a bullish report for gas oil from the inventory perspective. Not great from the demand perspective, I would say, but overall kind of bullish. And the light ends picture itself stays fairly bullish as well. So not particularly important signal on the stock side. Stock's still reasonably low. Demand very good for light ends in Europe and in OECD Asia, let's say.
Okay, so that's on the JODI side. But I also heard that there's more and more rumors that KRG might be returning to the international market. Is that something you heard as well?
Yeah, so that made a lot of the headlines this week, and it's something that has been on the cards, let's say, for a few months. There were a few headlines a few months back as well, but it seems like they want to accelerate the timeline, and that would be a big hit for various reasons. So that's maybe 300 kbd of Kurdistan crude, KRG crude, hitting the international market instead of kind of the internal market. There's still a lot of politics to get over. So politics between Baghdad and Erbil, politics in terms of this would get piped from northern Iraq through Turkey out to Ceyhan. And there's politics on the Turkish side to overcome as well. But that would be a fairly big chunk of heavy crude coming to market in the West. And what's also interesting from this perspective is that Iraq's OPEC quota, right? So there's lots of questions around how would this type of production be counted in Iraq's OPEC quota. There's lots of politics around that as well. Would Baghdad want to say they don't have control over the northern supply? So all that is basically up in the air. But it does look like there's meaningful progress on wanting to get this pipeline reopened. And then just the second thing on that is that headlines this week saying that, well, OPEC's putting out headlines saying that they might not up supply in April after all. So we're back to square one in terms of, at least the messaging right now. We'll see what happens in reality in the next few weeks.
Okay, and moving on into Russia, obviously we've been following the negotiations, and obviously this had a little bit impact on flat price. But going back to fundamentals, what do you think would be the impact? What will happen if Russian barrels start returning to the West? instead of the East, that's the current situation.
Yeah, so I'll start this off, and then I want to kick this off, and you guys can run with it, essentially, particularly in the fuel oil part. So we have to run through all the permutations. I was speaking with somebody last night. Do you think that the US would drop their sanctions on Russian energy or not? I sort of think there are signs that they might. Obviously, there's arguments for and against. I don't think that Europe will be taking Russian energy anytime soon. But even if the US were to drop sanctions, what would that mean? Definitely, they could take things like Russian resid. So Hua, you can kind of run with that thought throughout the rest of the pod. And I mean, the US has taken, for example, Urals before in the past. So what if you got 500 kbd of combined Russian resid and Urals heading into let's say the US fleet of refineries instead of the East? That's obviously quite a bullish signal for the East, and on the other side, a reasonably bearish signal for kind of sour crude markets and resid in the West, right? So all kinds of permutations on the board. I think I fall at the moment on the side of there's a risk that US drops sanctions on Russian energy. I mean, it's difficult to make any call on, of course, but that's my line of thinking just now as the risk.
Well, I mean, going into sort of like a geopolitical discussion here, but if the US does remove the sanctions, then maybe Europe doesn't do it initially, but let's not forget that there's a lot of countries like Brazil, South America in general, and there's a lot of countries that are not taking Russian barrels. This whole self-sanction system that a lot of, let's say, Western-friendly countries have applied, and if US is not doing it, they'll stop doing it themselves. And then Europe becomes the only one left that is sanctioning Russia. And obviously that with the dependence that Europe has on foreign energy, why would they be shooting themselves on the foot like that? So at some point they will be part of the negotiation, which is probably what the US wants to do anyway. It's like you don't have a choice, you will do whatever we do.
Yeah, a counterpoint to that would be Europe has already, let's say, successfully gotten rid of Russian energy from their system over the last 2 years, obviously with some price disruption. But, if you look at things like spreads today in gas oil and the crude market generally, Europe's now fairly settled on its slate, and there's more supply coming in. Like Europe, I think, is very much happy with taking things like Guyanan crude, which is relatively close in terms of freight. So they've already settled without Russian. Maybe they think, well, we save a lot of face, so to speak, by keeping our sanctions up.
Maybe. Look, I mean, it's a good point, but it's something to be seen. But obviously, when you no longer have the support from the US, then the whole thing starts to shake, and it's just a matter of time before you see those barrels going back to the West.
Yeah, could be.
But anyway, I mean, this, we could talk about this for ages. But Neil was mentioning about the resid impact. Maybe you want to comment something on that?
Yeah, sure, definitely. I mean, I'd like to actually see the piece used and the terms first before commenting on that. But in the past, the West used to be the more natural kind of home for these residual kind of molecules. Like the USG used to take a fair amount of the Russian high Suez trader and stuff. Nowadays, none anymore. Now they're taking from the AG, from Mexico, from their own kind of system. But really, I would like to kind of see the actual terms of the deal before we can say a bit more about that.
Good. Coming back to the East of Suez, that's the main topic today. And can you guys drive me through the key East of Suez developments, maybe starting with crude? June, anything that you can comment on that?
Okay, for the buying cycle, we are currently buying for April loaders, early May arrivals into the Far East. Turnaround season in Asia would be at its tail end during this period. CPC and WTI currently looks really too cheap in the East. We are seeing WTI about $150 per barrel cheaper than Melbourne landed into Singapore. And Brent Dubai has strengthened slightly since we called it, and overall still looking narrow. So our call is still the same. Continue to buy the dips on Brent Dubai. In all factors, Melbourne Premier should fall lower. Note, however, we do know that one CPC pumping station has been attacked by drones. And there may be some disruption to the flows. About 400 kbd over 2 months during the repair was the last reported. On the medium sour market side, we're seeing a weakening happening. There's plenty of spot Al Shaheen available. Upper Zakum as well trading at a discount to Melbourne due to lack of interest from the Chinese and Indian buyers. We need to see two factors play out, which may might delay the spot MEG weakening. Number one, there must be full evidence that the OPEC sanctions have found workarounds. And number two, the outcome of the potential Ukraine negotiations, whether the Russian recede or even crude staying in the Western Hemisphere instead of heading east. We just talked about it as well. Yeah. On Chinese refinery margins, the state-owned ones are seeing actually healthy margins. Run rates are reportedly at 3-year high. March allocations for Saudi barrels were lower than February, roughly 1.6 million barrels, dropping to 1.3 million barrels for March. So for this April buying cycle, there seems to be a lot of appetite for spot barrels. So putting on my refinery hat, what should I do? Number one, I will stay away from CPC for a little while due to the current supply risk that we are seeing, although it's cheap. Number two, Bonnie Light is cheap, WTI is cheap. Find a way to process more of this WTI Light versus Melbourne and DAS until the market rebalances again on the PG side. Whatever refinery margins that was so strong that we saw in the current month of trade is actually a result of the lower product supply due to the shortfall of crude buying last month, plus the peak TA period in March and April in Asia. This strength might not carry into May processing after all the refineries are back from the TAs. So my advice would be to consider hedging any runs on simple margin econs. Additionally, we anticipate light-heavy differentials to narrow again as the world stabilizes in terms of the medium sour crude supply. So there could be a timing play here. You can pick up potentially some cheaper medium sour barrels later in the trade cycles. Of course, the best way is go into Sparta platform, have a look at our crude rankings live, because these prices can switch pretty quickly.
Thanks for the marketing piece. And what about the teapot refineries? What are we seeing there? And I heard that there's some divergence of fortunes going on right now. What can you tell us about that?
Right. So the bigger independent refineries with integrated petchems, they are dominating the market. Rongsheng's massive 800 KBD refinery, they continue to buy TMX grades, which are the cheapest barrels if you can manage the high TAN, and Castilla crude from Colombia. Yulong, that started up in Q4 last year, is 400 KBD and is fully operational with its integrated 1.5 million tons per annum of ethylene cracker complex. Another 400 KBD train is planned to be started up sometime this year as well. Hengli is 400 KBD and Shenghong is 320 KBD. These are the other two big notable players in the teapot market. The second group of independent refineries are the smaller ones, which really depend on fuel oil as feedstock. They continue to bleed. There's the fuel import tariffs, the fuel oil consumption tax rebate reductions. Margins are negative there. Run rates are at multi-year lows for these refineries. We are hearing, obviously, in the market, they are getting ESPO, Sokol, Sakhalin blend again, all these Russian barrels, circumventing the EFRA sanctions by using new tankers. They even are using VLCCs to transport Sokol to Shandong. And privately run terminals in China have actually taken deliveries of US sanctioned oil tankers as well.
By the way, I love the fact that we talk about teapots when we refer to an 800,000 K refinery. Yeah, no, but that's...
We usually call them the mega independents.
The mega teapots. I always find that amusing. Anyway, and just before we move on to fuel oil, I also want to have your opinion on India and maybe Korea. I heard some developments there as well.
So we see that Urals is back into the Indian diet. Many players have worked to reconfigure existing deal networks to get around the sanctions blacklist. That's helping to bring back the medium crude supply, and thus our call for the narrowing of light heavy diffs. And of course, there's a big headline last week where Modi agrees with Trump to increase US oil and gas imports into India. How this will be implemented will remain to be seen, since India typically has so many other cheaper options than WTI. It's just currently WTI really is in the money versus other grades. On the Korea side, we wait with bated breath on any reciprocal tariffs, because at the moment, Koreans actually have a US FTA on crude, which allows a 3% rebate on WTI imports, which makes it very attractive even in normal circumstances to flow into Korea.
Okay. Now, moving away from crude, and I mentioned fuel oil before, but before we speak about fuel oil, on the naphtha and LPG side, can you please provide some details of, particularly the consumption side coming from China? I hear there's some changes there. I don't know, is it Neil or June, or you want to comment on that? June? Okay.
So there is a structural shift in a lot of Petchem units coming online in China. And this mostly happened in Q4 last year and Q1 this year. I'll name them out. Sinopec Ineos, 1.2 million tons per annum of C2. That started up in Q4. Yulong's 1.5 million tons per annum. Wanhua and ExxonMobil's Huizhou Petchem starting up in March. So all these have actually a flexible feedstock of both naphtha and LPG, and a few of them even have ethane as a feedstock. Zhejiang Petchem has a 0.6 million tons per annum of ethylene cracker expansion that will add in all of these a total of 7.6 million tons per annum of feedstock requirement in 2025 alone. So all these mega petchems will start up while the rest of Asia will see depressed petchem margins. On a side note, I noticed that when the tariffs was announced by China, they were very clever not to impose it on US petchem. Otherwise, there will actually be a big shortfall of particularly C3 for their PDH plants. So going to diesel, Singapore diesel pricing currently remains neutral to bullish, as despite receiving more AG and West Coast India imports, we are seeing that the Ulsan diesel barrels achieve stronger netbacks into US West Coast and Australia. And also talking about diesel, there's actually a lot of talk now about biodiesel in the Southeast Asia region. Indonesia in particular has already implemented a B40 standard, mandating from a 35% to 40% of palm oil mixed with diesel. The implementation is a bit delayed to February, but overall it will mean a lower diesel demand in Indonesia, which averaged 580 kbd in 2024. And we just heard the announcement that the B50 will be planned for 2026. Malaysia side is currently at B10. There's a plan for B20, but that's been very slow to implement due to capital crunch to upgrade supply chains. So we are seeing quite a few biodiesel mandates and goals, but essentially governments are just short of cash to execute.
Thank you. And now, Juan, moving to you on the fuel oil side. What's going on right now, and what are the exciting developments that you've seen recently?
Yeah, sure. Fuel oil is as exciting as ever, and the spotlight has obviously been on the high sulfur side in recent weeks, which we did talk about in the recent episodes. So perhaps I'll start with a little bit on the low sulfur side first, which maybe most people are not talking about it enough. And the reality is that the short-term picture doesn't look very rosy for the low sulfur complex in Singapore. And in fact, I put out a commentary yesterday about it. Fundamentally, it's looking like there's probably going to be pretty hefty build in the balance in March for the low sulfur, with a good amount of Western arbitrage cargoes arriving in the region, and the market is already reflecting that. If you look at Sing 0.5 spread, March-April is trading at I think $4.50, maybe $4.25 now, coming down from $7.5 per ton range that we saw just 3 weeks back. If you look at our Sparta break-even blender, even at these spreads and these I would say rather muted spreads and physical premiums, given where the latest Dangote LSSR tender close is actually still pretty workable into Singapore 0.5 blending. So we can expect that to continue being the general direction for these molecules. At the same time, it's still some distance away from being workable into 0.5 blending in ARA or the MET. And obviously, you could also make an argument for Dangote LSSR going to feedstock in the West, given that especially given that VGO is looking a little bit tighter recently. And the specs do look quite decent as feedstocks, but the reality is that the parcel size is just a little bit too big for most European refineries. Having said that, I do think that it can work into the USG feedstock pool, which can potentially help clear some of that. Again, look at our Sparta break-even blender tool. Our show is workable in 2.5 blending in both Fujairah and Singapore, but Singapore actually has started to look a little bit better than Fujairah in terms of value for any marginal outshore barrel in the last 2 weeks or so, which is pretty interesting development. Another development on the fundamental side would be the resumption of DAR blend export. So DAR blend export is resuming from a 1-year hiatus. The first cargo got sold recently at around, I think, $6.50 discount to dated, which is pretty weak relative to, say, the $3 discount that we used to get previously. And of course, some of that has to do with the low sulfur complex not really being, the most exciting thing in the world right now, but probably even more to do with, the fact that traders are not expecting the specs that they used to get. When you kind of like resume production from a field after a long time, you tend to run into a lot of, issues, maybe with the water, all sorts of things here and there. And even then, you usually have to, like flash this kind of material through the splitters in Fujairah or Tanjung and use the residue for blending instead of, directly blending the crude into VLSFO. So the fact remains that the export does seem to be resuming for real this time. And in the past, that's used to contribute, I think, some 3 Aframaxes a month to the Fujairah and Singapore blending pool. So it is a sizable barrel that's coming back. You also have Formosa putting the RFCC on turnaround for 3 months for the start of March. So, of course, they will reduce the crude runs. But in any case, you're likely to get additional supplies of low Suez trade run there into the region, into the Singapore region. And in fact, it's quite evident by the 35 KT LSSR tender that they closed, I think, was it last week or the week before? Yeah. So overall, from a fundamental perspective, does it look very good for Singapore low sulfur balance? Pretty heavy for the next couple of weeks.
Thank you for that. I appreciate it. And moving away from the fundamental picture, as we know for fuel oil, the blending aspect of things is quite telling, and it gives you a very good picture of what the art's going to be looking like, and obviously the influence that it will have on supply and demand. What can you tell us from the blending perspective?
Sure. We talked about Dangote and the Aljo barrels just now, and I think if you look at the blending economics that we are calculating with the Sparta tools, even at these, relatively muted levels of spreads and physical premiums, there is actually still plenty of, supply of decently cheap blending components into this region, which pushes blender margins for the region as a whole a good amount better than the historical average. So what usually happens in this case is that either the components start landing a little bit more expensively, or the physical premiums or spreads on the finished grades start coming down, or a combination of both. And usually the latter, in this case, like physical premiums and spreads coming down is usually the path of least resistance for the market. So that's, that's the fastest way for the market to kind of, quote unquote, correct the situation. So in short, if you look at, blending dynamics, it does look like the low sulfur spread did react the way we would expect it to, but you can also make the argument that there is a little bit more room to the downside. And honestly, personally, I can see structure even getting closer to flat from here.
Okay. And what about the high sulfur sides? So we started off with the low sulfur, but what are you seeing on the high sulfur? And maybe this can be tied to the Russian barrels that we were discussing before.
Yeah, I mean that's the questions that we we get a lot from a lot of people recently, right? So, and I know this is an East of Suez kind of focused podcast, but one thing that we haven't spoken about much is actually the U.S. Gulf Coast dynamics, which I think did have something to do with a further strength in high sulfur cracks from the beginning of February onwards. So in general, as a background information, the U.S. Gulf Coast is not really a big exporter of residue, but is very good at residue destruction, or in other words, upgrading the residue to more valuable products in the secondary units. And there are two sources of that residue for the upgrading process. So the first source is from within the refining system itself. So, that is by processing the crude and then processing the residue that you produce in the process. The Canadian heavy sour crude barrel has been an important primary feedstock for this route, as an example. The second source is external, that is importing either VGO or high sulfur straight run from somewhere else to be used for the secondary unit in the refining system. And in the past, this used to include the Russian high sulfur barrel that we talked about just now, that used to make this way to the U.S. Gulf Coast. But since 2022, obviously those barrels have turned, everything has turned to the east. So now the Mexican high sulfur and the Middle Eastern barrels make up the majority of this external source for the residual. So now what do these two sources have in common? Both the Mexican and the Canadian barrels were part of the Trump tariffs and still part of the tariff threats. The threats are still there, but everyone already knows that, of course. So what is also interesting is that if you look at the turnaround in the U.S. Gulf Coast, January and February is usually the peak turnaround season for the year. I think especially February right now, then that includes a lot of the cokers over there. So, and the next part is obviously a little bit of my speculation, but imagine yourself as a refiner you're starting to come out of turnaround. You need to think about how to get the feedstocks for your cokers going to March, going to April. And then you see all of these, talks about tariffs and both Canadian crude and Mexican residue, which would potentially make your secondary feedstock costs a lot more expensive. So quite naturally, you would want to go and buy some, say, high sulfur cracks to hedge against that risk as a refinery. And in this case, that would be the GC 3% crack or Rotterdam 3.5 Bash crack. So I think that did contribute to a lot of the strength that we saw earlier in the month on the western side. If you look at the US stock data, it does show, some seasonally low residue stocks. But if you look at spread, they are not anywhere close to spectacular. GC 3%, March, April is close to, I think, flat. April, May is like 70 cents per barrel, not stellar in any way. And in a way, so really spreads are not really indicating any sort of actual physical shortage here. But crack is a different story. And I do think the whole refiner hedging story that I just mentioned, the expectations of all these tariffs contributed quite some strength to the high sulfur cracks on the USGC side.
That's fascinating. Thanks so much. Also for me for the lesson on feedstock in the Gulf Coast market particularly. What about the strength in the high sulfur market in Asia? What do you tell us about that?
So there are various ways to look at the strength in Asia, and we actually already talked about a lot of that in previous episodes. We talked about the sanctions on the Russian ships making Russian high sulfur barrels, a bit harder to touch, discussed the stricter sanctions on the Iranian barrel. We also spoke about the strength in medium to heavy sour crude before, and these are all very valid arguments. They're all valid, so I won't repeat any of that here. But the fact remains that the East was quite a bit tighter than the West in terms of the high sulfur residue, though you could also say that, maybe artificially so, given that there is actually still a big pool of sanctioned molecules waiting to find their way in, and they will eventually. So whatever strength that you saw in high sulfur in the West, Asia also had to price even stronger, and there are two, reasons for that. First one is obviously to keep the best non-sanctioned the next best non-sanctioned molecules, which in this case is actually the Middle Eastern barrel in this region, instead of going out of region, going to the west, etc. And second, to potentially call for additional non-sanctioned out from the west to the east. So that was part of this whole strength thing. But now you're running into a pretty interesting situation. Demand destruction on the feedstock side has started to kick in, and this comes through various channels. For one, you have lower demand for the teapots that June talked about previously overall, and then that was from all the changes in the Chinese tax regime, and you also have lower demand from players that could optimize between crude and residue as feedstock. So the residue is also a competing feedstock versus crude. And this is particularly true for the Korean players or some of the mega dependent in China's people that could actually optimize between crude and residue as feedstocks. And given the very strong high sulfur crack that we have seen likely, I think this is actually quite likely this has tilted the relative margins between these two in favor of crude. So I think it's a matter of time before the market kind of start to realize that. And on the other hand, we are also likely some time away from the usual pre-summer stocking of high sulfur residue for summer burn. So summer burn is not starting until a few months later. And, they usually do a bit of stocking before that, but we're still a bit of time away from that, stocking. Will there be early stock of these materials? Maybe, but it's a little bit hard to justify that argument given, how strong cracks actually are right now.
Yeah, definitely. You wouldn't want to put more fuel to the fire right now and maybe wait a little bit for it to cool down. And I know that, we've talked about this in the previous pod. I wasn't here, but, I understand that you've talked about it. We don't want necessarily to speculate too much on Russia, but it's unavoidable. We need to talk about that. What do you think is, what is the market thinking about this particular barrel? I'm talking about the high sulfur barrels coming from Russia.
Yep. Yeah, that's a great question. And to be honest, I find it really useful about marketing material for you, Felipe. I find it really useful to look at what our Sparta high sulfur fuel oil blender has been saying about the economics of blending high sulfur in Singapore. And obviously, our blender focuses on the non-sanctioned barrels. So what you notice is that most of the time, for the purely non-sanctioned blender, in the region as a whole, they get a sort of negative margins, which makes sense. Now, let's look at how this margin has changed over time. If you look at the tool from the end of December into early January, this non-sanctioned blender margin actually got even more negative, like really, really negative. So what the market was saying back then was that a drop in the Chinese teapot demand for feedstocks for the changes in, like taxation in China would flood the blending pool with more molecules, these Russian molecules. And the market was telling the blender, sort of purely non-sanctioned molecules, to bring as little out to the market as possible, because you have too much of these like sanctioned molecules. Stop all of that non-sanctioned blending, that sort of thing, as little as possible. From mid-January onwards, as the stricter sanctions on the Russian ships came out, this actually reversed, which is really interesting. So the margins got better and better and actually touched small positive in early February for these non-sanctioned blenders. So what the market was saying then, if you look at the tool, is that it was sort of saying that there was not going to be enough Russian molecules in the blending pool in the short run from all these different sanctions, and the market was sort of encouraging the non-sanctioned blenders to bring out as much volume as possible. And then a couple of days later, which is quite recently, the trend reversed again when people started to realize that, okay, a lot of these Russian molecules will eventually find their way back into the pool again, one way or another. And now we are at a small negative margin again that's going sideways for a little bit. So you could tell that the market is really quite unsure between the continued sanctions and the impact of of a potential peace deal with Russia. And that's really how I've been reading the situation, looking at the changes in our blending economics.
Fair enough. Thank you very much. So just in short, what would how would you position yourself? Would you be bullish, bearish, these high sulfur barrels? Give us your opinion, market call here.
As an analyst, this is the least favorite part of the job, right? Or maybe the most favorite part of the job, making a call. But I did make a call on the low sulfur stuff just now. But I do think on the high sulfur end, high sulfur complex is on a little bit of a shaky ground at this time. At this point, I do think that the risk is probably bigger to the downside here, at least in the short term. So
there you have it.
Yeah.
Pause market call on high sulfur fuel oil. So we'll come back next week to see if you were right or wrong. Neil, anything else you want to talk about today that we have maybe missed?
Oh, there's always things to talk about. I think it's great listening to Hua. It seems to me, I kind of agree with the high sulfur complex. Not that I'm super up to speed with what's going on with the blending tool. Hua's the expert there, but it does seem like high sulfur is mirroring what's happening in the sort of spot Middle East Gulf crude premium, right? Mm-hmm. So just to kind of hammer that point home, we've been saying for 2 weeks in a row, look how cheap WTI is in Asia, and look how cheap Bonnie Light and other WAF grades are in Asia, and why isn't the likes of Murban coming under more pressure? And one read of that is that there is still a lot of fear around in terms of, are we going to be missing high sulfur barrels, basically, both in crude and in fuel oil? I think those two things kind of mirror each other, as they often do. And we've said multiple times, also earlier in this pod, we think that sanctions are going to find a workaround. So all else equal, that would point to high sulfur barrels looking shaky. It does point to Middle Eastern spot premiums looking shaky, unless something huge happens, like we just discussed, 500,000 barrels a day of Russian resid ends up in the US, then things change. But it's great having the high sulfur fuel oil perspective mirroring what's happening on the crude market.
Yeah, no, I'm extremely glad to have now these opinions on the fuel oil market. It's definitely something that we were missing. I was in Dubai last week and met a couple of fuel oil traders that they were complaining that we don't talk about fuel oil enough. So here you go, guys. So look, I think we've covered most of what we had to talk to today. June, anything you want to add, or this is enough for the special East of Suez pod?
Enough for this session, but have anyone wanting to discuss with us sitting here in Singapore?
Yeah, so actually next month we'll probably have another guest coming here. I'll be back in Singapore and we'll have a conversation with a special guest. We'll announce the name later on. But until then, this is it for us today. And thank you very much for listening. And I'll see you next week.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.